So Fawzi, thank you for sitting down with me today. It's good to see you again. I thought, given the journey you've had, I suppose prior to Cornish Metals on the sell side, and then the last 2 years, which have been enormous, it would be really interesting to hear your learnings, observations of the market and perspective, particularly as one of the few resource companies that's listed here in London and doing really, really well. But maybe before we get into that, for people that aren't familiar with you or with Cornish, do you want to give a brief background as to who you are and what your role is at Cornish?
Yeah, no, certainly. So I'm Fawzi Hanano, Chief Development Officer at Cornish Metals. I look after corporate development as well as investor relations and currently a big focus on project finance for the project. Cornish Metals, very quick background. We own the South Croft tin project in Cornwall. It's a historical mine, and we're putting all our efforts into bringing this back into production to be a domestic producer of tin, where there's currently no tin production in all of Europe, UK, North America, and this is a critical mineral. So that's our journey, and we're hoping by mid-2028 to have this mine back in production.
Fantastic. And I'm going to go off-piste immediately and ask you a question that we hadn't prepared. Chief Development Officer. So there are, by my count, very few Chief Development Officers here in London. I think it's a brilliant role to have someone that is specifically focused on the PLC side of the business. Why? Can you give a little bit of history as to how that came about at Cornish and how you found the role?
So first, I guess, to explain on Chief Development Officer, some people do get confused as to the title, because some companies, the role has the same description as I've just provided, but others, it's very much more technical. I have to always make sure to explain it's not a technical role, it's more in the corporate office. Now, how it came about, I think it came about as Cornish Metals over the years has been growing, and so the need for someone to fill in this role came about. It was previously being done purely by the Chief Executive Officer, but as you can imagine, as the company, the project continued to advance, his role, he was being pulled in other directions, and so there started to be a little bit of a void with regard to someone focused 100% on the business development of the company, the investor relations, and now financing being extremely important, and that's something that I can work on almost full time alongside my colleagues.
I think it's a brilliant idea, because you're right. If we were to look at some of your peers, they might have part of this function done by the CEO, part by a CFO, part by a head of IR. Maybe there's a business development person in there as well, and maybe a separate corporate development or analyst. Yeah. Do you think it makes a difference having one clear owner, and also quite uniquely having that owner firmly in the C-suite, as opposed to a head of IR, a head of BD who might sit just outside the C-suite?
On the second part of the question, I think it does make a lot of sense that this individual sit within the exco of the company. It is a very important role, especially for companies in this stage of development. Now, in terms of whether to have all this in one role or have it separated, I can't say it's better or not. It really depends on the company, the stage of development. For some, you need to have a head of IR separately because there's so much to do. But as we'll talk about a little bit later, with small cap pre-production AIM companies, the IR function is not that of a large cap, where you have so many more institutional investors to deal with. So it allows me to split up the role without having to undermine any parts of the role. But if sometime down the line there would be a need, if not for a new head of IR, for example, but for some more backup in that function.
Yeah, fantastic. Okay, so changing tack slightly, in your position as a public leader, what has been the best piece of advice that you've ever received?
I'd say the best piece of advice, and this applies to my professional and personal life, it's to just keep level-headed, calm and collected, no matter the situation, whether it be facing challenging meetings with investors or media, whatever it is. It pays dividends to sit back and be very calm and not react to things.
And what's your tip for keeping calm and cool-headed?
I say just take a deep breath, reflect, and take a pause.
Yeah, I think that's, I mean, this has come up in previous conversations in a different form where the advice has sort of been not everything, you don't need to rush everything. So that particularly in public markets, there can be a great deal of external pressure to do things straight away because the market is very fickle and very impatient, or it can be, not all of it. And so there can be this great pressure to do things very quickly, make a decision, respond to something, but you don't have to. And it's actually okay to take a step back, pause, or even just take a longer term lens with how you're reacting to things. But I think, the market can sometimes demand very short term results, but it can sometimes pay dividends, particularly in a exploration company where every overnight success story is usually 7 to 10 years in the making, can make a lot of sense to take pause. All right, well, let's flip it around. What about the worst piece of advice you've ever received apropos running a listed company?
I'd say one of the worst pieces of advice was to ignore the retail investor.
Okay.
Maybe it's something that worked 20 years ago, but definitely not in this day and age.
Why do you, I agree. I think I've been hearing that less and less over the last 5 years because it has become harder, I think, for the more traditional part of the market to ignore. But why do you think that advice comes up? Where does it come from?
Well, it could be that you could spend a lot of time servicing the retail, which is very true. As much as others, retail are deemed to not be there for when a company, especially a development company, is looking for funding, and that is very true. However, retail has played a big role for liquidity of illiquid stocks, where you have a few, like a handful of strategic long-term investors who do not trade at all. So you're really relying on the retail to trade the stock and to hopefully react in a positive way on news flow. And retail also tend to be, they provide sometimes the good and the bad noise about a stock, so they cannot be ignored in any way. So while you may not see the immediate return on investment, I think it's always important to treat all shareholders as closely as you can, even if you don't see the dollars coming in on funding events.
Yeah, well, the way I think about it, I wonder if you'd agree, is certainly institutional investors are going to be your sources of funding, but funding is a factor of price and finding the money. And you're probably far more likely, particularly in the early stages of company, to have retail investors setting the price, and then it will be they're setting the price at which the institutional investors enter. And so their role in a capital raise is a bit more indirect. It's not just liquidity so that people can trade in and out, but it's also setting the price, which is just as, if not slightly more important.
Yeah, no, super important. And we do hope that it's not fully set by the retail side. There is some institution and less, on the retail side, you tend to see a little bit more emotive trading that happens. And time horizons are very different, especially for a company like ours, where, as you mentioned, it does take multiple years to get into production. So you could see some emotive selling on the back of announced delays or that sort of thing, which could be overly punitive, in my opinion. But it remains extremely important, and over time, as a company moves forward, increases its liquidity and institutionalizes the register, they see more liquidity and more price setting by the institutions alongside the retail.
Yeah, that's fair. So with Cornish, how have you approached the retail investor engagement side of things?
I think key is making sure that the market as a whole, I try to look at the market as a whole, don't say retail or non-retail, that they are well informed. No one likes vacuums of information. Right. That does happen sometimes for reasons you cannot control. There might be delays in completing a study or a review, and you may have promised something that may be delayed, and that creates some unease with the investor base. But I find just keeping them up to date as often as possible, even if it's just a small update, just to demonstrate things are progressing on plan. If things aren't on plan, to again go out and provide an update as soon as practicable to kind of reset the expectations. and that you maintain trust. I think that is the most important, is really maintaining trust with the investor base, institutional and retail alike. And to devote time in terms of, for example, conference attendance, to not ignore the retail-specific conferences, to make sure to attend at least once a quarter, for example. Have these recordings put onto the website so they are available, and also providing a way to be in contact with the company. I've realized on the retail side, not all, but majority, I would think, of retail investors shy away from sending questions over email to the management team.
Well, they think they're not worthy of the time.
That's correct, exactly. So it's just providing a route to do that, where their questions can be seen and responded to. And a bit of a plug here, I find, with InvestorHub having.
So it's not rehearsed. Normally there's no selling allowed, but I'll allow it.
But I feel being able to respond to a question that is visible to all is very important, because it's not always comfortable to respond to questions by email, especially if they are questions where you feel that others need to know about them, which then, the right way around that would be to then, okay, why don't we put out a press release or social media post if it's not anything material, just so everyone's aware of what's happening.
I think that, the frequent communication in an authentic way is really important. And, the mental model I use is it's not dissimilar from how you would think about an institutional investor. For most companies, their sort of top 20, 30 investors will have a direct line to you or the C-suite, and you will update them. If something's happening, if an announcement comes out, there might be a call to give some context behind it. No new information, but just explaining it and making people feel like they are connected to the story. And what you're describing is just a more, scalable and time-efficient way of doing that with the tail end, which is really important. Because to your point, I think whether we like it or not, every investor is important, because it is possible for everyone to log online and buy and sell shares. And no one, particularly, which we'll get to in a second, here in the UK at the moment, is in a position where they can say, well, actually, I'm quite happy with the number of investors I have and the liquidity. I'm happy to not have those investors. I think it would be quite silly for anyone to say, I don't want more investors. And so, all really good points.
I think I'd add to that another point, is that a retail investor can be one of your top 10 investors and can be one of those who does provide funding. And that is the case with us as well, where we do have important retail investors who've been supportive along the way. So you can't put all retail investors into one bucket, assuming they're all small investors who are not very knowledgeable about the sector or about investing as a whole. So that's something to bear in mind as well.
That's a good point. Much like there can be institutional investors who might come in at size in a capital raise and could be out of the position within a matter of days or weeks.
That's right.
Can equally happen on the other end. Just to double click on that point, something else that I think you've done really well at Cornish is how you've engaged the local community. And within the retail segment of your register, you have a lot of domestic investors who are from the area, who are familiar with the project, and who are very engaged with what you're doing. Has that been a deliberate part of your strategy to take advantage of the fact that this is a local project that has a lot of local interest? And yes, from a sort of community stakeholder relations perspective, it's important to keep that engagement active, but also there's a great many people that can become quite loyal supporters and shareholders.
I wouldn't say that was the strategy. For any mining project or manufacturing anything, you need to have that social license to operate, and you need to have everyone, the whole community within your area of influence to be on board. So engagement is paramount. So they're all aware of what is going on, and the plan for the project. So that was the intention up front, and that's something any mining project would agree that that is the best way to move forward, because there are multiple projects that have been halted due to not having engaged properly with the local community, and so have not delivered on expectations. You can't always deliver everything, but you have to at least know what these expectations are and try and incorporate that into the strategy of the company. Now, it is a bonus to get investors on the back of that, But at the same time, we've seen companies where they have involved the entire community, a lot of whom have become investors, and it's a tough pill to swallow when these investments go sour. And that has happened in multiple projects across the world, where they garner a lot of investment, and it may not be the fault of the company. It could be the macroeconomic environment wasn't right at the time. Companies go under. The whole local community suffers as a result. Some would put in their whole pensions into a single company. Never advisable. Always speak to your financial advisor.
Yep.
But it is a bit of a double-edged sword. You do want to have the involvement of the local community and their support, which we do have through continued engagement, and that goes not just local communities, but the local council, local government, national government. That is key support that we do need, and if there's additional investment that comes that way, that's always a plus.
I think, well, I guess it just comes best way to sort of safeguard against any bad outcome is just clear, authentic messaging, and not overburning, overselling. If everything is clear and consistent, then everyone is on the same page. So maybe using that as a segue into a broader conversation on what it is like being a resource company listed in London at the moment. And just to tee this up a little bit, fair to say that over the last few decades, the total part of the LSE pie that is occupied by the resource sector has shrunk. There have been a number of larger names that have left the UK. There have also been a number of smaller names that left the UK, and an even larger number that may have in decades past chosen to list in the UK that have gone to Canada or Australia. So you're part of a smaller group, but you've been able to find engagement and success through that. What do you think are some of the key things, let's start at a macro level, that have changed over the last decade or so that have contributed to that?
I'd say on the macro level, what led to the resources sector becoming such a larger component of the FTSE, for example, through the early 2000s, early mid 2000s, was really China coming onto the scene. I think that's really led the way for commodities demand to go in hyperdrive, pretty much from 2002 through till about 2011.
Yeah.
And from that point, things really did start to turn. China did build up quite a lot. They were reliant on fixed asset investment.
Yeah.
That was the tool that was used by the government to really keep the economy moving and to achieve their goals of urbanization and of building out the country. Now that a lot of that has been done, and that transition towards more consumer-led growth, that hasn't been as quick as previously expected. And so commodity demand in China is not what it was previously. They still remain the largest consumer.
Yeah.
We're looking pretty much across all commodities. China still consumes around 50% plus, some up to 70-80% of the commodities. But it's very different to how it was before when we're looking at the supply side. Because that led, over the last 20 years, that led to a huge amount of investment in supply growth, which we're seeing right now. And so there's still a lot of tightness in a lot of commodities and some critical minerals, much more so than others. But I think that's what's changed very much on the macro side.
Yeah.
And so while that was happening, pretty much any market, the mining sector was doing very well. It was very buoyant up until around 2011, 12, when things started to change a little bit, and we started to see things crack. The huge amount of M&A activity.
Yeah.
And if you look at all of the M&A that did take place between, say, 2008 up until 2012, probably about 90% plus of the value of these transactions have been written off because they're purchased at the top of the market ahead of the decline that started to ensue. And that's brought on a lot of restructuring, especially to balance sheets that were a lot more levered at the time. But now we're looking at the mining sector being having a lot healthier balance sheets, a lot more cash being returned to shareholders by way of dividends and buybacks. I think that's been led by the investor to a certain extent, but we need to see a bit more of a return to growth.
Yeah.
I think that is very much needed now, given that we're seeing for a lot of commodities that there is an existing and growing deficit that we're seeing. If you want to see some of these, I wouldn't say net zero targets, but reduced emissions targets across the board to be achieved, you need a whole lot more copper, tin
Right.
and other commodities, and the investment isn't there. I find that a lot of the corporates are taking a more conservative approach of let's see the demand in front of us, we're not going to invest ahead of that.
Right.
I think that's what's kind of changed quite a bit. Now, how has this affected mining within the scope of the overall indices, especially within London? Like you mentioned, quite a few mid-large companies have exited, whether it be voluntary or privatization, acquisition. That just means that there's much fewer from that side that are traded in on the LSE. But on the small cap side, I think what's really impacted the market has been liquidity, more than anything else. MiFID II had a very big impact on research coverage.
Yeah.
And I think that's also kind of impacted liquidity as well, and exposure of small cap pre-production AIM companies to the broader investor base, where previously any analyst used to cover a lot of these small cap pre-producers, whereas now you would find many AIM companies that only have coverage from broker relationships, which is a shame. And I think that's one of the biggest
it's a different
changes.
type of research as well.
It is, of course.
Yeah. I mean, just on that, so in London specifically, I mean, you've had the benefit of sitting on the sell side. You were an analyst for how long were you an analyst?
For a dozen years, yeah.
Dozen years. And now you're on the issuer side. So you've seen that full journey. For other public leaders that might be listening who are in the resource sector, what are some of the key things that have sort of changed about how you need to approach running a resource company on the LSE?
Well, I think you have to do a lot more yourself.
Yeah.
So you need
What
to
do you
do
mean by
more. Well, the companies need to be more proactive, need to engage more directly with their audience. I think that's, in the past, there was pretty much everything was done through a broker.
Yeah.
Mid, large, whatever it is, that was kind of the way it was done. And I think that's changed, especially for the smaller companies where you cannot rely fully on the broker. You need to do more on your own. And of course, like we discussed previously, there's more retail involvement as well. And we've seen some of the large companies as well start to devote more time to prime brokers and various other smaller funds that cater to retail, because that is seen as growing demand for the shares.
Yeah, okay. So I guess like the investor mix has changed.
Yes.
And as a result of MiFID II and other sort of structural, social, technological changes, the way to go about engaging with investors in any form, whether it's raising capital or to communicate, is a bit different and more disintermediated than it has been in the past. Is that fair to say?
That is fair to say, yeah.
So specifically, if we've got let's drill down on those three key points, which tend to come up a lot for when I sit down with public leaders in the resource sector. Firstly, liquidity. And we may have already answered this in passing by talking about retail, but for a resource company in London, it is, you're sort of starting from a slightly harder position than, say, or at least it looks like you're starting from a harder position. Maybe you might disagree, than in Canada or Australia, where the market, or at least in Australia, which I can speak about more authoritatively, people have more familiarity for the resource sector. They grow up around it a little bit more. They don't see mining and resources as a dirty thing necessarily. And they're also more likely to invest actively in equities. That's quite different to, or at least I feel like that's quite different to here in the UK. Outside of retail, do you think there's more that a resource company needs to be doing here to attract liquidity, specifically in London?
Well, I think any company has to target global funds.
Yeah.
So we're not just limited to funds that are operating out of the UK. We can speak to funds in Australia as well as funds in the US and Canada. Some do have restrictions, especially in Australia. You tend to see more investment only within Aussie listed or Aussie exposed companies. But elsewhere, yes, you do have some that have a much larger local investment requirement. But I think it's on the management teams to expand their marketing outside of their region. Of course, it is easier, like for us, for example, having the project here in the UK, it is a natural fit for the UK market. But at the same time, the commodity is traded globally, and we have peers in Australia, in North and Latin America. So there are other investors who are invested in the sector and in our commodity that may want other exposure. So it's really looking at what the peer group is and where you could seek out other investor targets. Now, in terms of familiarity of the investor base to mining, the UK has a good knowledge base of mining, and traditionally it always people always say that Toronto investors know Latin America a lot better.
Yeah.
UK investors know Africa a lot better, and tended to be the case. But now that's kind of fading away, and people know the various commodities as depending on their interest in these commodities. Now, Australia has attracted a lot more in recent years, a lot more small cap miners, and I think there's been quite a lot more interest, and the markets have been more buoyant than what we've been seeing here in the UK. Will that happen all the time, forever? No, maybe not.
Yeah.
But I think at the same time, not every company is suited for the ASX.
Yeah.
And really that comes down to what the commodity exposure is, location of the asset. We have to kind of think about does it make sense if you've got an entire management team and assets sitting in Western USA or Canada. Is it right to be to be listed on the ASX?
That's a good point. So maybe it's not quite as much of a silver bullet as it seems in a zoomed out perspective to, say, well, I'll just move my listing to America and suddenly get all this new liquidity, or I'm a small cap explorer and I've got a gold project. I'll move to Australia and I'll suddenly be able to raise millions of dollars. Is probably not quite as simple as what you're saying.
No, exactly.
No. And so going back to your international investor point, because I think that's a brilliant one, like one advantage of borders breaking down between markets and the increased globalization of information and markets is that it is much easier to reach different investors.
Yeah.
How have you gone about doing that? Has that been, you were saying before that the whole process of reaching investors is becoming a bit more self-led and direct. Have you literally been trying to find a list of the relevant funds in North America and just reaching out to them yourself? Has it been self-led, or how have you gone about it?
Well, it's a combination. I'd say we've been trying to use our brokers a little bit more for that, and using different brokers. Those that have more exposure to North American markets, for example, attending conferences in North America, that gives us a bit more exposure to investors that we don't traditionally see. So I think that's kind of, we're leading it. So we'll do our own investor targeting exercise, and we say, okay, do you have relationships with these investors, yes or no? If yes, it's always easier to go through an intermediary that already has a relationship.
Yeah.
Otherwise, there are some times where we do some direct communication as well. A lot of times these are investors that we or myself would have interacted with in the past, in a former life. And just in terms of the international remit, a lot of these investors, in my analyst days, I'd go marketing Europe, North America, Middle East, Africa. I would a lot of times speak about the same stocks to all these different investors. That goes to show that they do have an international or global remit.
Yeah.
And so you shouldn't ignore investors just because they're sitting in a different part of the world.
Just takes a bit of work.
Yeah.
Yeah, fair enough. And then, final point on the way that resource companies here should approach the market on capital raising. So resource companies pre-production are very resource hungry. That's sort of part of the strategy, an inevitable part of the process. Raising capital, I suppose the outside perception is that's become a bit harder. How have you found that with Cornish? Has the way you've approached that changed? Has the source of the funding changed, or any commentary there?
Well, I'd say it is hard. And what could have been done, say, a decade ago, quite relatively easily, is not the case anymore. Yeah. A lot of pools of capital have either dried out or kind of changed their focus, become more, less invested in very early stage development companies. And what we've seen has been necessary for a company like ours is to have a strong strategic investor, and not just one. So, we had listed our name in 2021, and that was mainly a lot of small and institutional investors raising £8 million. But that's not enough to really get things really moving. It was not until the following year when Vision Blue Resources stepped in, anchored a £40 million raise, that we were able to really move things forward and progress things at the project. So that strategic investor was Paramount. And then earlier this year, the National Wealth Fund invested and became a second strategic investor. So each one owns just around 29% of the company. So pros and cons. Pros are we have very strong supportive investors who we expect will be there for completion of the project financing. But then you're tying up a lot more of the ownership with very few hands that are long-term, not trading. Right. So it has an impact on liquidity at the same time. But I feel that there is an absolute need for strategics to be able to get your funding goals.
And if I could draw a thread here that maybe isn't appropriate to draw, but also good market signals to have. So strategic investors are not just money, but they're strategic in helping with the development of the project, but also to other investors serve as a very good signal in the same way that pre-MiFID II maybe an abundance of very high quality research coverage would be a good signal. Maybe this has sort of sat in place of it a little bit as well.
Yeah, certainly, because these are investors who are astute and have done a good deal of due diligence on the project and the company before taking the decision to invest. So yes, it is a very good signal, and we're always told that by prospective investors and shareholders, but they don't all take the decision to invest, and whether it be macro impacting them. This year has been quite turbulent since the beginning of the year with Trump presidency, tariffs. That created a lot of uncertainty, inflation, the rate path. All of that has caused uncertainty, and investors do not like to invest when there are uncertain times. So that overshadowed what we believe would have been more support, given the support that we did have from our strategics.
That's a good point. To go back to something you said before, so you were previously a research analyst for 12 years, and you'd made a passing comment that the role of research has changed. To talk about that a little bit more, what has changed there, and maybe a more direct question, do you think it is still relevant? Or for a junior resource company in times gone past, there would have been a great deal of money and effort spent into accumulating coverage. And it was seen as a way to establish credibility, help connect the dots for investors and get distribution. Do you think it is still as important as it used to be? Is it still something that junior explorers should be pursuing with as much vigor?
I think they always have to continue to pursue it. And the ultimate goal is to have unpaid for research, so independent research from the banks, not to chase the big banks. As a junior, sometimes the distribution is not fit for junior minor. But to get some of the smaller banks to provide independent coverage. Now that's very difficult because it usually comes with strings attached, which wasn't the case in the past. I think also the model for research analysts has changed. There's a lot more pressure. The number of stocks coverage per head has increased. In the past, you would have seen, on the very large cap mining space, analysts covering 4 to 8 stocks, for example. But they are the subject matter experts on these stocks, and some of the smaller cap guys covering 10 to 20, somewhere there. Now, it's not uncommon to see coverage of 30, 40 stocks. So that becomes very challenging. And I think that also dissuades the teams from picking up other coverage if it's not, they don't see the direct benefit to the team or doesn't fit within their research coverage. But at the same time, they just don't have the time. So I've noticed that a lot of research teams have shrunk a lot compared to what they were before. It's not just mining, it's across the whole research space. But at the same time, I think it's still important. In the large cap space, it remains very important. The investment community rely on the sell side to gather a lot of the information, see their models, and when it's independent research, you hope to have a decent distribution of buy, sells, and holds. Give investors the opportunity to really hear different points of view, and sometimes it's company specific, country specific, commodity specific, whatever it is. We're lacking that in the small cap space, and I think it would be good to have unbiased information out there because it's lacking in the small cap space.
Would you say find someone to pay for it?
I'd say it's very important to think through the narrative. What is the purpose of the company, and how company wants to be perceived by the public and work towards that. I think it's very important to have a very refined and well-explained narrative for the company. Define the goals, timeline, time horizon, all of that. It needs to be a relatively simple story to get people interested. And seeing that on the small cap pre-production side is going to be a lot of retail, but I think the management teams all need to do a lot of work in terms of cultivating strategics. Something I mentioned before. I think it is key for companies to advance their strategy and with regards to funding, to have strategic investors involved early on in the process. In terms of liquidity, that's quite challenging. I'd say continuing to be engaging as much as possible across the board, all different types of investor bases, targeting small mid-cap institutional investors and retail alike, and having significant exposure to try and increase liquidity. It doesn't happen overnight. Sometimes it doesn't happen until you've gotten past that stage on the Lassonde curve and de-risk the asset significantly enough. It's something companies work on really hard, and it's hard to see the benefits. It sometimes takes a lot of time, but you have to keep at it. I don't know how many bits of advice have I given there, one or two. I don't know. What else is there? I think it's just being transparent. It's quite important. As part of the engagement, it's very important to build that trust. It's hard earned and easily lost. So to things happen, things change. Companies need to be upfront about it, and not be seen to be concealing anything from the markets. Yeah,
fantastic. Well, Fawzi, thank you for sitting down and having this conversation. If there are any, sorry to put you on the spot like this, but if there are any of your peers in the sector that are interested in connecting with you and hearing more, or maybe they really resonated with something you said and they want to talk to you more about it, are you happy for them to reach out to you?
Always happy to make new connections.
Fantastic. All right. Well, thank you, Fawzi.
Thank you, Alex.
Cheers.